Well, thank you so much, Sarah. Good afternoon, good morning, good evening to all of you. My name is Ignacio De La Maza, and I have the pleasure to be moderating this panel that covers the topic of decentralization of supply chain. For today's session, we have two portfolio managers who are experts in this topic, and they've been managing money for many years in Janus Henderson and have experience extended in investing in US equities and in emerging markets. So Jonathan Coleman, who is portfolio manager and has been investing for more than 29 years in small caps, and Matt Culley, who is also portfolio manager and has been investing for more than 15 years in the markets. So Jonathan, Matt, thank you so much for your time. I think over the last 2 years, there have been a lot of conversation about decentralization of supply chain, considering some of the different changes we have seen after the pandemic, but then also the situation that we have in the geopolitical around the world. So if I may, I will be asking you some of the questions that we have received from the audience, and hopefully we can cover some of those points that are of interest from the people listening to it. So Jonathan, if I may, I will start with you. So how does deglobalization and the decentralization of supply chains affect the economy in the United States prospectively?
Thanks, Ignacio. Sure, a lot of things to consider. I'll try to hit on some of the highlights. I think one of the first implications that's a very large one is that we will need more workers in many industries, which is going to be very good for employment levels in the United States. According to the National Association of Manufacturers, the U.S. needs about 800,000 more workers in manufacturing, and that's on a base of about 13 million total employment in manufacturing today. So it's not insignificant. We're going to need more automation in factories to scale up production. I think a focus on decentralization of supply chains is also going to reduce our reliance on China going forward, which, given geopolitical concerns, may be a positive. I think all of these things are going to increase supply chain resiliency going forward, because we'll be manufacturing closer to the ultimate consumer of those goods. And all things being equal, all of these factors are going to be inflationary to the U.S. economy. So that's something that we're going to have to be aware of and deal with. But at the same time, this will have a very positive multiplier effect on the U.S. economy. The service economy contributes about 70% of GDP. And when workers have more money in their pockets, they spend more money on services, which creates a positive flywheel effect. Census Bureau data show that about $108 billion was spent on manufacturing related to construction activity in 2022. For perspective, from 2015 to 2021, that averaged about 75% annually. So just in the last year, we've had over a 40% increase in the amount of money spent on manufacturing related to construction. And I think that's part of an early trend that will continue for years to come. As a negative, we may not have enough skilled workers to meet the demand for their services, as I talked about, according to that National Association of Manufacturers assessment. But on balance, we believe that this will be a positive, long-lived impact on the U.S. economy. For perspective, it took 25 plus years to offshore production supply chains. And I think nearshoring and onshoring will probably happen much faster than that, but will still provide a decade plus of tailwind to the U.S. economy.
So thank you, Jonathan. I think that to that point that you've been touching, I will pass it to Matt now on basically the topic of China. So Matt, from your point of view, which countries are the beneficiaries of supply chain diversification away from China? How well positioned are these companies to deliver? And we can talk about countries like India, Vietnam, Philippines, but then also, do you really see an investment opportunity on the back of this?
Yeah, it's a good question. So we actually do see that as really a key driver for investment returns in EM over the next decade. And we really have to rebuild a lot of the supply chains that were built in the early 2000s. But I think what's different this time versus what you saw in EM 20 years ago is that a rising tide probably is not going to lift all boats. Some countries are going to benefit disproportionately, but it probably also won't happen at the same China speed that we had after China entered WTO. So like you said, I think the key beneficiaries are going to be Mexico, India, Vietnam, and Indonesia. But remember, it's not just about labor arbitrage. Unit labor costs in Mexico, for example, have been cheaper than China for the last 10 years, but it hasn't necessarily taken off like you otherwise would have expected. It's also about the ability for countries and governments to be able to build out the logistics capacity and then deepen the breadth of the supply chain. We're actually seeing a lot of really interesting innovations brought around like digital freight forwarding and digital cargo logistics to kind of increase the efficiency of those trade lanes from Mexico to the US. I'd also highlight Indonesia as another great example where historically they've been very fortunate with a lot of natural resources. But increasingly what we're seeing today is the government's been creating an investment-friendly framework to encourage local investment, to move up the value-added curve. So instead of just exporting some of the critical commodities for electrification and green energy, for example, they're pushing for the construction of refining capacity and manufacturing facilities to be able to create end products. So instead of just exporting raw materials, they're verticalizing and bringing more of that benefit in-house. India has, obviously they're demographically very blessed. And Vietnam has been kind of the rising star in Asia for a while. One interesting stat that I like to note is Samsung represents almost 10% of the GDP of the north part of the country, already driven by this theme. So I think that the broadening out just turbocharges the long-term prospects for Vietnam as well.
So Matt, thank you for covering that point. And I think that we go back now, Jonathan, to the US. Now that you have been covering some of the talk about the economy as a whole, how does decentralization of supply chains affect the investing environment in the United States?
So I think there's some really interesting implications, Ignacio, and one of them, which I hit on in the first question that you asked me, was that wage inflation is likely here to stay, especially in industries with worker shortages. I think that's a clear implication on the investing front from what we've talked about. Second would be that companies that can't automate some of their workflows or raise prices to offset the higher wage bill that they have are likely to see operating margins compress, and that's something that we should be aware of. Third, I think there's an opportunity to look for regulatory and government spending tailwinds in legislation that's passed. We've seen two big opportunities over the last 12 months in the CHIPS Act and the Inflation Reduction Act. And there's state incentives as well for lots of companies to locate manufacturing in certain states that seem to be very business friendly. Next, I think being flexible and agile as a company is very important in this environment, and the need to have some redundancies in your supply chain. One of our small cap companies shifted production to 3 separate Asian countries outside of China before COVID hit. And this allowed them to continue manufacturing when their China-based competitors were shut down. So that's something to keep in mind. And then next, a couple more implications around I think the shortening of supply chains could be good for free cash flow. Companies should be holding less inventory, all things being equal. This could help returns on capital, which would be good for many companies. And then lastly, I think we're likely to see less cyclicality in certain industries because we're going to have fewer inventory corrections. Oftentimes when goods are manufactured a long way away, companies don't react quickly enough, and they don't understand that there'll be a glut of supply. But if we're manufacturing closer to end market demand, I think we're likely to have less of that supply chain correction dynamic and ultimately less cyclicality.
I think that is the point on the US demand. We move it to the emerging markets, and the demand that some of these companies might have from the North American or European customer for greater supply chain diversification. How is this dynamic good or bad for shareholders of those companies?
Yeah, it's a good question. If you think traditional outsourcing businesses, because that's a lot of what emerging markets have done, right? We produce things cheaper, better, and faster. But they have to today contend with the cross currents of potential stranded capital, i.e. they've already built some supply chains and manufacturing in China. And they also have to contend with the prospect for increasingly investing fresh capital in regions that really don't provide the lowest marginal cost. So again, as Jonathan said before, that's necessarily inflationary and likely margin dilutive. But they also have a lot of their customers who are saying that this is a strategic imperative for them. So one thing that we're starting to see is a deeper engagement with global multinationals on how to share that cost, but that also includes the governments, and like Jonathan said, around the CHIPS Act and the IRA. In India, for example, for the number of schemes that they put out, notably Make in India and PLI, where global companies like Apple and Hyundai are engaging with the government on how they can economically shift some of their supply chain into India. As remember before, it's not just about setting up a manufacturing facility outside of China. Because again, it's not just labor arbitrage, it's a lot deeper. The breadth of the component supply chain is so extensive in China that the cost and speed of doing business has developed over many years. So a manufacturing facility without a similar investment in nearshoring components, it really won't achieve the desired outcome. If final assembly of an iPhone is in India, but all of the components are imported from China, does that yield the desired supply chain diversification? Probably not. So again, it's a much deeper and more drawn out conversation with this regard. So what does that mean for a lot of the companies? Ultimately, it means that the big likely keep getting bigger. It's those companies who have the scale to help re-architect a lot of the supply chains that are going to be able to command a fair return on their investment. So the threat of Chinese substitutes in, let's say, the Apple supply chain, for example, is likely going to lessen, but there's going to be some upfront capital required. It probably also means, companies like Korean semiconductor companies, they're going to have to work with the US government on the CHIPS Act, but then they also have to balance a lot of the geopolitical risks of a big chunk of their manufacturing base still sitting in China. So in short, the benefit is not going to be uniform. For some companies, it's a great opportunity, and for others, I think it's definitely more of a risk.
I think that to the point, I stay with you, Matt, that you were covering this. There is some dominance of the Chinese industry in certain areas. And I think how feasible is for North America and European to diversify away from Chinese EV battery supply chain. Is this realistic? Is possible?
Yeah, to put it short, it's difficult. But maybe just let's step back and let's set the stage. So the largest EV battery company in the world is a company called CATL in China. The second largest is the company LG in Korea. And the third is actually the largest volume producer of EVs in the world, BYD, again, out of China. And so I characterize the evolution of the EV battery industry to be very similar to the semiconductor and memory industry, where we've seen Asia really dominate the industry. A large part of it is labor arbitrage, but again, it's also down to the maturity of the component supply chain and also working culture. For simplicity's sake, an EV battery can really be broken down into 4 subcomponents. There's the cathode, anode, separator, and electrolyte. And the largest players and essentially all the manufacturing capacity happens to sit in China and Korea. And so share also continues to migrate toward a lot of the leading players in those geographies as well. So I would also mention there's also a working culture difference that's also very important. Part of the reason why TSMC has dominated the advanced manufacturing for semiconductors and Samsung and Hynix have really consolidated the memory industry is a critical part of winning in these industries comes down to companies' ability to solve manufacturing complexities at scale and with speed. And so engineers are willing to work around the clock to be able to solve yield issues and move the manufacturing process forward. So that's not something we're necessarily going to see here in North America and Europe. So if governments put incentives to build manufacturing capacity out west, we're likely to see final assembly move, but I think a lot of the IP is still going to sit in Asia.
I think that, thank you so much, Matt, and really interesting. And let me bring it back to Jonathan as an expert of the US. So all this decentralization of supply chain that we've been covering, are there any direct beneficiary of this trend in the US that you would like to mention or to refer?
Yeah, thanks, Ignacio. I think one of the things that we like to keep in mind and keep at the forefront is that you need to understand what the U.S. government views as strategic. And a couple areas stand out to us on that front. One would be semiconductor manufacturing with the CHIPS Act, as we've hit on. EV batteries, as Matt was just discussing, and the extent to which we can help support domestic innovation there. Medical supply manufacturing, pharmaceutical and biotech manufacturing. I think it was quite alarming as from a societal perspective, the fact that we had outsourced so much of those critical functions to China when the COVID pandemic hit, and a real understanding that we would be better off as a country making sure that we had a meaningful source of manufacturing and supply near shore or onshore for those areas. I think there are a couple other areas that seem to be direct beneficiaries to us. One would be capital goods. I discussed the significant increase in CapEx associated with manufacturing capacity going on in the United States over the last 12 months. We expect that to continue. Automation as well, which I've hit on before with the worker shortage. The focus on automation is going to be very important. Consulting. So lots of companies know that they need or want to onshore or nearshore, but they don't know how to do it. There are a lot of businesses, a number of businesses in the publicly traded markets that help companies understand how they can affect this change, and they're likely to be beneficiaries as well. And then lastly, engineering and construction companies. With all of this manufacturing going on, somebody has to build it, and the E&C companies can benefit substantially from that. When I think about kind of other beneficiaries, I think Matt talked about the scale benefits to large cap companies in some of his emerging markets. I think that's likely true. I'd put a positive spin on the opportunity for small caps to perform well in the United States as a result of this trend, because their ability to be more flexible and agile and respond quickly to the needs of customers, may allow them to move a little quicker than some larger and less sufficiently managed large cap companies.
So thank you for that, Jonathan. And I think that, conscious of time, we have time for one more question that is coming from the audience, and I'm going to be reading to both of you if you can cover. I will start with you, Matt. What are the other themes that you are thinking about at the moment, considering this topic?
I think that the critical thing that we're thinking about across emerging markets, outside of just supply chain diversification, really is innovation. I mean, Jonathan just touched on biologic capacity manufacturing in China, but we're starting to see that also shift to India. We're seeing that shift to Korea. And what that does is it creates a base for innovation. So companies and employees who are working to create that manufacturing capacity are now starting to see what it can potentially become, and starting to create a lot of really, really interesting businesses. So if you look across emerging markets, we have the vast majority of the digitally native population, so the most number of internet users. So they have all of the information known to mankind at their fingertips. We have the largest number of STEM graduates, science, technology, engineering, and math, by like a factor of 5. And also, we now have all of the preconditions that are kind of ripe for innovation. So you have a lot of educated people who are now starting to return home and trying to found businesses to be able to solve a lot of the unique inequities. And it's historically, emerging markets has all been about how do we outsource and use cheap labor. And increasingly, now that we have a lot of educated and digitally native people, it's how do we take that upwardly mobile society and be able to provide them goods and services. So think about providing financial services via fintech. Think about providing healthcare via new innovative biologics. That's not something that happened 10 years ago or 20 years ago or even 5 years ago. One interesting stat is that if you look at the weighted average internet penetration in emerging markets, it's roughly where the US was in 2007, 2008, 2009. So we saw what happened in the US equity markets over the following 10 years, where a lot of these really innovative business models really drove great returns. We're seeing all of the same things that we saw 10, 20 years ago in the US start happening in emerging markets. And it's a really interesting time today as global interest rates have come up dramatically. Valuations for a lot of these businesses have come down a lot. So we're really starting to see innovation taking off, and we're at kind of this really critical juncture where we're able to find who are those good companies with the best business models able to differentiate themselves for the long term.
So on that point, I would like to basically wrap it up here. Matt, Jonathan, thank you so much for your input. I know that there will be other questions that we have not been able to answer, but we will be coming back to you with the input. Jonathan, Matt, thank you so much for covering this topic of decentralization of supply chain. And definitely, as you can see, and you have basically shared to all of us, there is plenty of opportunity on anything that happens in the markets. So thank you so much. And I pass it back to the studio. Thank you so much.
Thanks, Ignacio.
Thanks, Ignacio.